Hey guys, today I want to talk all about the commonly misunderstood 457B plan. But before we dive in, if this is your first time joining us, welcome. My name is Michael Foley. I'm a certified financial planner and certified student loan professional, and also the son of two doctors. And design lifestyle creep really to help the healthcare workers in our society and really be more intentional in their finances and hopefully inspired to live more humble and quiet lives as well. But so let's dive in. We get a lot of questions on the 457B plan, and so thought I'd do an episode just kind of breaking down the different types of 457B plans, because a lot of times, people understand the differences, and it could be a catastrophic difference between these situations, as you'll see. So I want to kind of map out, when we're talking about 457B plans, these are what are called deferred compensation plans. So a deferred compensation plan is what it sounds like. You're deferring some of your compensation to a future date. So that means that if you put some money into there, it means you don't have to pay taxes on it if you're putting in a pre-tax contribution to a 457 plan. So what that also means is that it can go into two different types of accounts. So not everyone's going to have access to a 457 plan. It's going to be through some sort of nonprofit employer. But if you do, it's really important. The biggest question we have to ask, is it a governmental plan or is it a non-governmental plan? And it's really hard to know the difference before you're really diving in and asking HR, and we'll go through some questions to ask HR to help determine if they can't give you a straight answer as well. But let's break them down. What makes them different? So the 457B, the governmental plan, is pretty much like an extension of your 403B or 401k. So you can put money into it. It doesn't count towards your limits on your 401k or 403B plan. So if you can put $22,000 to your 403B, we could put another $22,000 to the 457 as well. So whatever the limits are for that year for the 403B or 401k, the 457 is going to match that. So that's going to be your limit on how much you can put into it. So it's very similar to these plans. They have the same limits. They also have creditor protection. So a 401k or a 403b plan is going to fall under ERISA, which is essentially government protection of retirement plans. So that means that people can't touch that. People can't sue your employer and get access to that money, right? People can't, if your employer closes down, they can't get access to that money. So it's a lot of very protected, but the 457Bs are what are called non-qualified accounts, so they don't share the same protection under ERISA. However, governmental plans, they're actually held in a trust, so that it does prevent that ability for if your hospital system were to go under, the creditors can't go after the 457B money if it is governmental. Not so much on the non-governmental, so we'll talk about that in a minute. So we have the creditor protection. They're so similar to the 401k or 403b that you can actually even roll them into like an IRA or another 401k or 403b in the future. They're that similar, which is nice. But as you'll see, we may not want to, depending on what your goals are in your plan, okay? So the nice thing about the 457B plan is since it's not under the ERISA protection, you don't have the requirements of when you can take that money out. So with the 457 plan, you can take that money out whenever you want. There's no waiting until 59 and a half like there is with some of the 401ks or the 403Bs, because we can't take it out without a penalty in those types of accounts. But these, there's no penalty, so you can take it out. But the big catch is if we take that governmental 457 that doesn't have the 59 and a half rule and we roll it into one of the 401ks or an IRA that does have the penalty, now we've just made that money now inaccessible to us without penalty. And so we're going to be subject to that 10% if we take it out before 59 and a half. So just something to be thinking about before we just automatically move that 457 money. It's usually the common practice to do, but if we're planning on retiring potentially before 59 and a half, then it would be kind of nice to be able to have access to this without having to lean so heavily on other non-qualified investment accounts, okay? The other thing is that there are often, not all of the governmental 457B plans offer this, but some of them do allow a Roth contribution. So the Roth contribution is a little bit different. So you have the same limits. You can still do up to the $22,000 on top of whatever you're doing through your 403B or 401k. So they're in completely different categories. So what that means is that we could technically, if your employer allows Roth contributions to your 403B, and you're making full $22,000 contribution to the 403B, you could do a whole nother 22,000 to the 457 Roth, and now we just doubled how much we got into the Roth, each year. But since the Roth in and of itself has a 59.5 rule, you do have to abide by that 59.5 rule if you make Roth contributions. So just something to keep in mind, because Roth is a separate category. Okay, so that's something to think about. So let's talk about the non-governmental. So these can be really advantageous or really scary if you're not aware of what the parameters of your 457 plan are. Okay, so they're going to also have the same limits of your 401k or 403b, so the same like 22,000 or whatever it is in the year that you're contributing. But there's no creditor protection, so it doesn't go into a trust. It's not really even your money yet. It's still the employer's money that they just kind of earmarked for you upon whatever the terms of the agreement are to when that deferred compensation comes to you. However, if something happens to that, to the hospital and they dissolve or they go insolvent or what happens, which sounds kind of ridiculous when you're looking at like a big hospital system, but we've seen it, right? And this stuff happens. And so creditors for that hospital could go after and raid the 457 B accounts for any non-governmental plans. So it really isn't your money, and it's not protected until that is actually in your possession. So it's essentially just a promise to pay in the future, as opposed to actually an account like you have with a governmental plan or another retirement account. Okay, so that's something to be thinking about. So since there are different rules and there's different guidelines on that, you can't roll a non-governmental plan into either a governmental 457 or any other retirement account type. The only thing that you could roll it into is potentially another non-governmental 457B plan, but it's really rare because they both have to match up and they both have to agree to it. So it's very rare that they're both going to agree to that sort of arrangement. But the big thing too is, with the governmental, you can roll it in and just take your distributions out in retirement. Over here, they dictate exactly what your distribution is going to be, and so it's important to ask those questions of saying, okay, when do I get to take this money out? But better question is, when do they force you to take that money out of that account? Because let's say you've been working at an employer for 10 plus years, and maybe we have a couple $100,000 in a non-governmental 457B plan. Well, let's say you change jobs. Well, maybe one of the guidelines for their distributions is that when you leave that employer, you have to take a full distribution of your 457 money. So that means that now we have to add an additional maybe $200,000 or $300,000, however much is in the account, to your taxable income in that 1 year. And so that could be a huge tax burden for us. And if we're not aware of what those guidelines are or how we can take that money out, it can be incredibly detrimental. And so we want to make sure that we maintain control in our plan and not get blindsided by some taxes that maybe we could have been more strategic with and spread it out over some years. So some plans do have opportunities to spread it out or different things, but all the more reason to ask those questions, just because if it's even a possibility that they could require you to take it all in that year that you get either terminated or you leave your employer, that's cause for worry, right? We got to make sure that we know exactly how we're planning for that, and maybe not putting as much towards that plan. Okay. So as a general rule, both can be used as a fantastic vehicle, but we just want to make sure that we're being strategic within our overall plan, because a lot of our clients just want to just kind of put that as the default of saying, hey, I'm matching everything out. Well, that may or may not be the right thing for us, though, because if we're matching everything out, one, have we looked at our retirement projections? Do we need to be saving that much, frankly? Or could that be used for something else to get more life out of the money that we have now, right? Or are we putting money into something that could potentially cause us maybe a higher tax burden in the future on something like that, right? These are good things to know, but a lot of times in the plan, we're using the 457 plans as kind of like a blow-off valve if we want to put more money towards retirement and we want more tax advantage places to put that. This is another place. This isn't usually the default that we do, so just something to be thinking about as we're going through that. But the big thing that we also get questions on is, is mine that we have through that you have through your employer, is it a governmental or non-governmental? It's the biggest question, and it's much harder than you think to find the answer to that. And so I put together some questions that you can ask HR. Oftentimes, if you email HR, they should be able to give you a direct answer on that, but if they aren't, here's some other questions that you can ask them that will help you identify if it is a governmental or non-governmental, right? So the one question is you can ask them, can it be rolled into an IRA? And so if it can be rolled into an IRA, well, we know that the non-governmentals can't, and so it has to be a governmental plan. The other one is, can you take loans off of that? And that's something we didn't talk about, but you can't take a loan off of a non-governmental plan. So we don't really encourage using loans off of your retirement account. Let that be for your retirement. Don't take loans off of that. That's kind of like a dire straits kind of situation if we need. But it's more just a qualifier to figure out if it's a governmental or non-governmental. So if you can take loans off of it, it's a governmental plan, okay? The other one is, can you make a Roth contribution? That's if you can make a Roth contribution, that's likely going to be a governmental plan. But if you can't make a Roth contribution, that doesn't necessarily mean that it's automatically a non-governmental, because not all governmental plans do allow for Roth contribution. So don't use that as a total weed out, but it'll again help us kind of divert us to the right answer there, okay? So again, 457B plans, commonly misunderstood. Doesn't necessarily need to be that default switch that we hit to max out everything. Use this as kind of a blow-off valve if we want to save some money in taxes, or if we want to defer more money, if we need to defer more money for our retirement plan in conjunction with everything else that we're trying to do in our overall plan. So hope this has been a helpful episode for you, breaking this down. And if you have other questions, our team is more than happy to help and look at your situation, see how we can help you out as well. So feel free to reach out, and hope this has been helpful, and we'll talk to you in the next episode. Thanks so much.